Happy Friday, everybody. So it's time for another weekly tax planning video. So today I kind of want to talk about the home office deduction, how to utilize it, how you can get aggressive on it, um, how to be more conservative on it. So these are all just kind of um, just some ideas about the home office deduction. Now, I will say this, make sure you talk to your tax professional or tax advisor before you do take any stances on a tax return that might be considered a little bit more aggressive. So this is, you should always ask your professional for advice. Okay, so the home office deduction. There's a lot of myths about the home office deduction. So history on this, it used to be kind of a high risk, high audit item, and it still can be. It can be considered a red flag. It just depends on a couple of different things at play. Um, and the reason why is because, honestly, the IRS kind of works in the 1950s. They don't understand that people can run very successful businesses completely online, working from home. For example, I have clients that are selling on Amazon that order inventory from China, and then they ship it to their home, and they're basically using their home as a warehouse. But if you're taking a sole proprietorship or a disregarded entity type stance on your tax return, and you take a home office deduction and you claim something like 90% of your home or 50% of your home for your home office deduction, then there is a good chance you're going to get audited, because the IRS doesn't understand how you could actually run a business using that much of your home. Well, you're shoving inventory in every nook and cranny, you're going to win that audit, but why cause an audit? That's expensive. So yeah, so there is a red flag there if you're a sole proprietorship. Now, if you are a corporation or an S corporation, you're actually not capable of working from home. The corporation has a physical employee, you, and therefore that physical employee has to have a physical place to work. Corporations don't have a home. They are not you. They are separate from you. So they send you rent to rent office space from you, which also happens to be your home. And that's actually a Department of Labor law. So this happened during COVID. All the corporations, all these big companies sent their employees to work from home. Well, they didn't compensate their employees for use of their home like they're technically supposed to per Department of Labor laws. So there were a couple of lawsuits filed at the end of COVID for that. I'm not sure exactly how they turned out. They kind of disappeared from the news after a few months. So I'm guessing they got settled and hidden so that it wouldn't be as big a media issue. But anyway, that is the law. So the law is the corporation is actually supposed to reimburse you for use of your home or provide you with rent income. They give you rent income, and then you take it on your personal tax return as a rental schedule. So that's actually technically how you're supposed to do it. And so then you can write off your office space. So that would be if you own, depreciation, your standard utilities, and if you rent, your rent expense, your rent monthly rental, and all utilities. Okay, so so that's one way you can get aggressive. So our threshold, to move somebody into an S corporation is a benefit to expense analysis. So typically, a sole proprietorship or a disregarded entity, it's not worth it to take more than about 20% of your home. For one, it's just going to throw up a red flag with the IRS, cause an audit, and two, your income levels are low enough that you haven't met the threshold to move into an S corporation yet with our firm and our analysis. Therefore, your income out of the disregarded entity isn't going to be enough to warrant much of a home office deduction anyway. But as soon as you meet those thresholds, we put you in an S corporation, and then the S corporation rents office space from you. So you actually don't even tell the IRS the amount of space you use, or the percentage of your home that is utilized for a home office deduction. Now, like I said, we might be taking 90% because you're shoving inventory in every nook and cranny, or maybe depends on how you're utilizing your home. And we could win the audit if the audit comes. It's just that we don't want to cause a $5,000+ audit merely because we've got high percentages on your home office deduction. But a corporation doesn't report those percentages because it's just rent expense on the P&L. Okay, so those are kind of some of the background and kind of the stances we take. So what is the rules for the home office deduction? So the rules are basically every expense associated with your home goes into this calculation. So that would be your rent or your mortgage payment. Well, not really the mortgage payment itself. Principal repayment doesn't count, but interest does. So the interest portion of your mortgage payment counts, and then property taxes and insurance, and then all your standard utilities. So power, water, natural gas, sewage, garbage, pretty much, like I said, any expense really associated with your home that could take into account HOA fees, lawn care, pool maintenance, repairs and maintenance. So if you have a plumber come in and fix your toilet, that would go into this calculation. So basically, it's every expense associated with living in your home. Now, typically, phone and internet are considered 100% business, so those don't even go into the calculation. Those are paid out of the business bank account, while all the other expenses are personal first because they are your personal living expenses. So you pay for them out of your personal bank account because we want to have separation between your corporation and you. And so all those expenses are paid for out of your personal bank account, and then the corporation reimburses you for that. And that could happen in a couple of different ways. That could be a check, actual cash flow from your corporation to you to reimburse you cash dollar value. That could be you take them as a deduction on your corporate tax return. You could just do a non-cash transaction if you're a single member LLC. But you got to think here, we have separation between individual and business, just like if you were an employee at Microsoft and you got sent home during COVID and you got reimbursed for those expenses. So basically you would have paid for all those expenses out of your personal account, and then Microsoft would reimburse you on your W-2 for those things. So that's kind of how we handle it. All those expenses go into this. We pay for them out of our personal bank account, and then we allocate it back to the business during the tax return preparation. So that is based on, when we come up with that allocation, the percentage is based on two rules. The first rule is wherever you're physically operating your business from does have to be 100% business, and the IRS can get nitpicky on that. I've read some interesting court cases involving a guy who had an Xbox plugged in. Basically, he lost his home office deduction all over an Xbox. So you do have to have it 100% business. What does that mean? That's hard to say, because I know I've worked at firms where we've had an Xbox plugged in upstairs. I've worked at firms where there's a pool table or a ping pong table to decompress in between tax returns, or a hard thing. And I know there's other businesses that do several similar things. I think one of the big things in Silicon Valley is to have napping pods or stuff like that, right? So a whole bunch of different things that you could do at a regular corporation that just wouldn't be acceptable in a home office. So your home office does need to be professional looking based on your industry. The second rule can be a little bit more favorable, and the rule is if you have any business assets in storage, they can be commingled with personal stuff, and you still get to count the space as business use. Business assets in this rule means pretty much anything physical the business owns. So examples of that could be a vehicle, could be inventory, could be clothing. If you run a cooking show, like a podcast or something, that could be the food in the pantry. Just some different things there. Again, this would be a conversation with defining. So this can be used as an aggressive stance when you look at this rule, or it can be more conservative depending on what you and your tax professional decide. I've heard some CPAs say we we allocate the use of the storage space. So if you're using 50% of it for business and 50% of it for personal, then we would only take 50% of the storage space. Other CPAs tend to look at the rule as a whole and say, okay, well, if your garage is used storing of business assets, we use the whole garage regardless of whether there's some camping gear or some other stuff in storage in there. So there's one way you can get aggressive. So then you would take, total or business use square footage based on those two rules divided by total square footage of your home gives you a percentage, and then you get that percentage of all your expenses that we've talked about. So then you can look at it a couple of ways. How are some additional ways you can get aggressive on it? So another way you can get aggressive on it is, let's say you and your significant other both work from home and you both work in similar spaces. So this one is kind of up for debate. I kind of look at it as like a shared office space. There's lots of businesses out there that now offer shared office space where you can come in and rent a computer or something, and or rent the conference room, or, and a whole bunch of different people can come in there and work in this shared office space. So your expenses are going to be similar to the person sitting right next to you. So I take that same stance, which could be considered aggressive on your home office space. If you and your significant other work in the same office space, you could take the same expenses. That might be, you're not going to take 100% of your entire living, but you could put, 100% of, when you're calculating this, if you were going to this other place, there would be some sort of profit built into it. And so more of an aggressive stance would be that you each list 100% of your expenses and then take the percentage, as if you both were renting separate offices. And that was so. If you say you're using 20% of your home for business, you take 20% of all your expenses for each of you. That would be one way to do it. That might be considered more aggressive. Another way to do it would be you're using 20% of your home for business, so you take 20% of all your expenses and then divide it by 2, so you each get 50% of that. That would be another way to do it. Or another way to do it would be to only take the home office deduction on one of your tax business returns. So one of you gets a home office, the other one doesn't. So those are 3 different levels of varying aggressive to conservative, depending on what you want to do. So again, these are all different ways to think about it and how you could get more or less aggressive on the home office deduction. Again, it's all your expenses, and actually go through and figure out how you're utilizing your home so that you can take more deductions. Last thing I'm going to say is, there's this stigma out there that it's kind of getting less and less. It used to be more. COVID kind of changed everything, but there's this stigma out there that if I'm running a business, I really want to make it, so I want a brick and mortar office. I felt that in the past. I know other people do. But you can think of it this way. If you go out and you get a physical brick and mortar, you're going to have all those expenses in the brick and mortar, and then you're going to duplicate those expenses in your own home. So if you have the ability to work from home, why not just have one set of those expenses and write them off as a business deduction? So that's a way to save on cash flow. If you don't need to, let's figure out a way to avoid getting an actual brick and mortar as much as possible, because then you can save on cash flow and you can save on taxes. Okay, so I hope this video was helpful for y'all, and think about how you can get more aggressive on your home office deduction and determine the amount of risk or the amount of less risk that you personally want to do. Until next week. Hope everything goes great with your business.